Philippe Cloutier, President and CEO of Cartier Resources, listed on the TSX-V with the ticker symbol ECR. We're a Canadian gold explorer focused in the Quebec portion of the Abitibi Greenstone belt. Our flagship property is the Chimo Mine property, just east of Val-d'Or.
Philippe, really good to see you again. Nice to be talking to Cartier once more. We last spoke in September, I believe it was, and you had a catch up with Matt. Since then, in November, I believe. Since then, the gold market has had a bit of resurgence, a bit of a pop. There seems to be more interest in gold now. The gold price has risen from 1650 to 1950, and we're just below that at the moment. So we've had the kind of a $300 gain in the share in the gold price. Before we get onto your assets, have you had any kind of inbound? Have you had a change of communication or tone with your shareholders or with investors? You know, have you felt the love of that rising gold price?
A bit, really. We're right off of the tax loss selling season. We're appreciating the fact that the price of gold is going up. A lot of our investors are less nervous or less depressed than they were at the end of 2022. I have to say, they are anticipating and they're expecting, obviously, more drill results and the PEA that we're to file before the end of the quarter. So overall, the mood is a lot better than it was ending of 2022, for sure.
Good. And to a degree, I guess your existing shareholders are already sold on gold. You know, you're preaching to the choir in that sense. But, you know, are you speaking to anybody new who kind of, who's saying, oh, maybe this is the year for gold, or I need to be in gold because of the financial risk of other assets or the dollar or currencies?
Indeed. And I think it's coming off the fact that I guess a lot of letter writers and analysts are saying, listen, a lot of these gold juniors are at all-time lows. Yet a certain group of them have kept advancing their projects. You should be looking at them. So we're getting some of that that are knocking on our door. And I've recently come back from the Vancouver 3-part show. There was a roundup, which was the corporate audience and professionals. There was the Metals Investment Forum, which was letter writers and analysts and high net worth. And then there was the VRIC, or Vancouver Resource Investment Conference, which was mostly retail and some conferences. So there were 3 different audiences, and they were very well attended. So the mood there was very positive. There are crosswinds, right? There seems to be an interest in very high interest in the lithium market. So that's what we're competing with right now. But companies such as Cartier, with cash in the bank, an asset such as Chimo, and the level of advancement at which we are, well, you know, we're really proud to be where we're at right now, and we have news flow coming. So it's a good place and good time to be for a Cartier shareholder.
I've been talking with Matt that we feel that kind of 2023 is going to reward the companies which have got the financial ability to complete their goals this year, and that have had their kind of valuation to a degree crushed by the horrible 2022 that has just been passed, and yet fundamentally are in a better position.
Yeah, no, that's right. A lot of good stuff got done in 2022 by Cartier and by other companies, and I think we have to agree that a lot of that went unnoticed or wasn't rewarded. But the name of the game is just, you know, when you have an asset, when you have the financial means to keep advancing and keep being relevant, well, you just have to soldier on, and that's what we're doing. And I think companies or projects that are in premier tier 1 jurisdictions, such as the Val-d'Or mining camp or the Abitibi Greenstone belt, well, they're even more relevant to be looking at these days.
Okay, so let's look at Cartier specifically. I think it was early last year you kind of brought in the 03 resource block. You were thinking about doing a PEA, but that has been delayed. But you kind of incorporated that land package. Can you just talk me through kind of the evolution of your geological understanding and where you are now in terms of the PEA?
Absolutely. So we have to dial back just a bit. Remember, from 2016 to 2020, we basically drilled about 60,000 meters of with 124 holes in and around the shaft area of the past producing Chimo mine. We delivered 3 resource estimates, and by then we had delivered just about 2 million ounces, about 600,000 ounces of indicated, and 1.4 million ounces of inferred. And we really basically had drilled up to the property boundaries. So we knew this thing could expand east and west and also at depth. But those property boundaries were locking us in. And on O3 Mining's side, they had several deposits and showings, but nothing as big as the Chimo mine. So it made sense for us to initiate discussions in, I think it was November 2021, and we closed the deal by April 2022. So that was rather quick, but it was still a good quarter and a half of the first quarter and a half of 2022 to consolidate the land position. So Cartier now owns 40 kilometers of the Larder Lake break, the Cadillac Fault, east of Val-d'Or. And that 40 kilometers includes a 15-kilometer stretch peppered with gold indicated showings and deposits, which obviously includes the core of the Chimo mine project and the adjoining West Nordo deposit. So upon closing the deal, since there were 243-101s, we had to consolidate the resources of West Nordo deposit with the Chimo mine project, because the West Nordo deposit was sufficiently proximal to the underground workings of the Chimo mine project that it was feasible to do that. And so we delivered that resource estimate in August, and by then we also had redesigned a new drill program, which we launched end of August of 2022. And once we had the consolidated resource estimate, we took the handbrake off the PEA that we had initiated in 2021. Remember, we had initiated the PEA on the Chimo mine project, but when we saw that we were going to acquire the East Cadillac project of O3, we put a pause on that. So for those out there thinking that we've been at the PEA for a full year, no, we had to stop the PEA, wait for the incremental resource from the West Nordo, and now we've just recently taken off the handbrake of the PEA, and yet we're gonna deliver that by the end of the quarter, first quarter.
So the PEA is on the combined resource that was published in August, but you've also, in parallel to that, you set out a new drilling program. Where is, how many meters, and what are the aims of that new drilling program? We'll come on to the PEA in a second.
Well, yes, indeed. And it's very pertinent that you bring that up, because we launched the program with 2 machines. Our target is 25,000 meters, strictly targeting the extension of known gold zones within reach of the Chimo mine shaft and underground drifts. Okay. So we're not prospecting with a drill here. So obviously by the time the PEA comes, and as you've seen the recent press releases, the ounce count at Chimo is already growing. In the next few weeks, you'll see additional drill results from the West Nordo area and the East Chimo mine sector. As we speak right now, both rigs have been moved to just west of the shaft on shallow drilling, again, with the objective to grow the ounce count. So to your question, yes, the drill program that we initiated in August of 2022, the goal of that is to keep growing the ounces in and around the Chimo mine project. And so the PEA that we will publish, that will provide an initial economic assessment, will already be stale dated by the time it's published, obviously.
But so effectively, this is a 25,000 meter expansion program around existing resources.
Yes, we're not infill drilling or anything. We're simply trying to build it towards a 3 million ounce mark. Again, within a very short window.
Okay, so within a short window, you're aiming to kind of get an envelope around 3 million ounces.
Exactly.
With the PEA, what was the combined resource once you'd added in the
2.3 million ounces, 720,000 ounces of indicated, and I think 1.633 million ounces of inferred. And a lot of that inferred is in and around or proximal to infrastructure. You got to remember our drill program so far has been the design of it has been greatly aided by the fact that there's over 4,000 diamond drill holes in the past producing Chimo mine area. So we have a very good handle on the structural pattern there. And so our hit miss ratio has been excellent. I think if you've done the metrics, just under 60,000 meters, $13 million invested, plus the acquisition, we're tracking about $7 per ounce discovery rate. And there's no reason that should change as long as we obviously stay around the mine area.
And so you've got thanks to that database and your understanding of the geology, you've got a good hit rate on your drilling.
Absolutely. And so we're very happy with that.
Are you able to drill underground at all, or is this all from surface?
It's all from surface, and that's why we try to stay within the first kilometer and a half, the first 1,500 meters. We're hoping that obviously the next phase of exploration might include an underground phase, if so recommended by the PEA, to take it from that to the feasibility or pre-feasibility. But most likely, with the new resource estimate that will follow this drilling, we'll probably have to upgrade the PEA once again. We're trying to engineer the next exploration phases at Chimo to be as performant as the previous ones, and more rewarding than the ones that so far.
In some ways, drilling depth extents are very far dated ounces. They are way down any mine life.
Exactly.
Track, which they in an NPV basis, they get terribly discounted.
They get cut off after 10 years. The first 10 years they get cut off, and they're more than discounted. They're not even taken into account. So I'm seeing what you're getting at. You're getting at, Phil, are you going to concentrate most of your drilling in an upper tranche? And the answer is yes. We're seeing that. On one hand, we're seeing that we have to keep scoping the system and building an overall picture and see how far this can grow. And on the other hand, we have to build as much 0 to 10-year value that we can in a shallow environment.
And there's also that crucial kind of ounces per meter, but ounces per vertical meter, because what you don't want to be doing is have an asset which just you're on a hamster wheel because you've got so much development.
Well, the rule of thumb is 1,000 ounces per vertical meter, and this one is looking like it's going to be about 3,000 ounces per vertical meter. So we're okay there. What we're discovering, though, with the acquisition of the O3 mining ground, is that now we control about 100%. 100% of all that ground. What we're seeing is the center of gravity of the system is shifting more towards West Nordo, at least for now. So if you had to redo the shaft today, you would not necessarily put it where it was put in the 1960s, right? So and so we have to wrap our heads around how we're going to design exploration to make the best use of that infrastructure. And so it's a lot of moving parts to how this project's evolving.
And I don't know if you've seen, but Crux invested recently published a kind of a review of the problems that happened with pure gold last year. It went bust, and some of the problems were dilution. The mining widths were wider than the actual mineralized unit. The average grade that was pulled up to the surface was too low, and the other estimate was that the benchmark cost of mining and processing was estimated too low, so the cutoff grade was too low. So the costs, you are in an ongoing kind of cost loss making situation. So my questions to you are twofold. One, tell me about the mineable widths in this resource, and the other is, what are your cost estimates that you use on your resource parameters, please?
The cost estimate for resource parameter, that's being addressed in the PEA, so I'll defer to that. But the mining widths exceed 5 meters at Chimo. We're very fortunate that this is wide, medium grade mineralization. And more so, we've demonstrated twice now, 2 independent metallurgical labs, that this thing is amenable to ore sorting. So what I can say right now is that what's being looked at in the PEA is that we're looking to mine 4,500 tons per day, and yet through ore sorting, send to the mill roughly 2,500 at a grade of 5 to 6 grams per ton. So that's one of the benefits of the project, because the mineralized sites or stopes at Chimo will exceed 5 meters. And in some cases, they can go, 10 to 15 meters.
And where will those ore sorters be?
Surface.
Will you have to haul 4,500?
Yes, that initially we all thought, and this was cute, was to install the ore sorters underground, so as to manipulate the material as least possible. It appears that I think the area that they're going with, I haven't seen the final layout, they will put them at surface, and the material, the waste that is sorted out of the system will actually be returned underground for paste backfill and cementing some of the stopes.
Okay, good. So the PEA this quarter?
Yes.
Great. So that'll be
well, we're walking in for your audience here. We're walking into the end of February, early March, where there's a BMO show in Florida, followed by the PDAC, followed by a spring break. And generally that 3-week period, or that 2-week period of the BMO show and the PDAC, well, people or companies inundate the market with press releases. So I've been asked, Phil, are we going to compete with this? I said, look, whatever you do, whenever I'm presented with numbers, I've got 48 hours to disclose. So,
if they're material
or not, they have to be material. I mean, the results of a PEA are material. So for a company our size, so
good. Yeah, no, I tried to resist jumping onto we're going to release on the Monday of PDAC. I try to, I'd much rather see a good study properly done and properly peer reviewed and checked by the board than to.
Well, absolutely, exactly, and reviewed by the board. That will have its questions. Because the way PEA works, they provide with an executive summary, and then they have 40 or 45 days to file the detailed 700-page report type thing. And you're right about that comment about having a fixed date. I mean, I always, my eyebrows just raise when I see this, because listen, if you're calling the date of the press release, how is the independent consultant actually independent? I mean, when they're finished their work, They provide you, there's a short period where there's a Q&A, and then you file.
How much visibility do you have on the other operations in the Abitibi in Quebec? Because at an average grade of 2.5 or 3 grams a ton, even with the ore sorting, how much visibility do you have on kind of benchmark costs?
Well, in our case, we're running a scenario where we're building our own mill. So it's not going to be toll milling and assuming or using, another mill's cost. And first of all, if you had to do that, then that mill is probably, well, does it have the capacity to take your ore, and does it have to tweak its mill to accept your ore? So the costs are being run as if you're building your own site. and with the allowances that a PEA level work will give you, right? I mean, this is a preliminary economic assessment, and in no way a definitive, detailed, optimal mining scenario. That's done at the pre-feasibility and feasibility level. There will be more drilling. There will be, once you take it from the PEA level to the feasibility, then you have to do some infill drilling to take your inferred to indicated and so on and so forth. And mine design, material handling sequences, they start to change and refine. So it's a work in progress, a continuous work in progress.
And I guess we'll see the numbers which come out in terms of your kind of your operating costs. But it was more I guess it comes back to my earlier question, which is, you know, what the consultants will be using for their estimates for operating costs. But that'll come out in the PEA, I'm sure.
Yeah, I think they're using 1650 gold, and they're using the standard exchange rate. And they will, at the PEA stage, they have to go out and get certain quotes for, you know, electrical stations and things like that. And we live with that, right? And those quotes are provided to them with disclaimers, right? So that will all be disclosed as well.
Do you review your peers? I mean, do you look at the valuation of Cartier and say, well, we're trading at $25 million US, and we've got $2.5 million, and therefore we're trading at $10 an ounce? And do you look at your peers and say, well, we're cheap relative to our peers?
Yes, we do. But I've been asked to compare ourselves and to show ourselves in light to our peers, to say how better we are or how much more undervalued we are. But I don't tend to do that. I tend to focus, and our group tends to focus on advancing Chimo. So internally, yes, we do try to compare. We try to compare apples with apples. So, I mean, we're not going to compare a peer that has an open pit deposit on a porphyry gold or copper play in South America to the PEA of our project. We try to compare local stuff that have comparable local costs, local access to manpower and infrastructure. And I think there are very few comparables. You know, there might be O3, there might be Probe, there might be Radisson, Manita, and then some of the senior producers have lookalike projects with the same types of grades and cutoffs. Yeah, we could use those as comparatives, but I mean,
in a sense, what I'm driving at is you know, what do you want your investors to think? Oh, that's a realistic target. We're trading at $10 an ounce, and or our market capitalization is $30 million Canadian at the moment. Realistically, in a year, we can be $50 million, or is it $150 million? You know, what's the goalpost? You know, give us a hook.
Well, it's good that you mentioned what's the goalpost, what's the hook. I've done that before, and I've actually I've set a goalpost or a milestone, and I've reached it. But by the time I reach it, the retail market moves the goalposts, and that could be quite frustrating, because then you fall into the trap of listening to armchair quarterbacks and that's where the danger happens, where you always have to keep building and advancing your project on your technicals, your scientific facts, your metrics, and not the wishes of an investor that is comparing you to another group or another geology or another deposit. So I understand the comparison approach, but I warn people that when you start doing that, the companies that get led down that path, more often than not, they're not listening to their geology and their model and what suits their deposit.
Okay, well, another way of looking at it is that investors need to feel comfortable that you're going to finance your objectives. So you've said your objectives are PEA out Q1, continue drilling, hit 3 million ounces, and then presumably advance to kind of the next economic study. With that, first of all, with a PEA update, and then presumably infill drilling pre-feasibility study.
Indeed, but we're seeing with this drill program that the West Nordo area is already rewarding us beyond expectation. So once we wrap up this drill program, we will most likely continue drilling in that general area because those ounces are building up faster than, well, they're building up faster. And that's where we have to pay attention because ultimately it's going to impact the center of gravity and the mine design of the next.
Yeah, you alluded to that. So if I can get my head around, you're at 2.3 million ounces, and with a little bit of expansion work, you can get to 3 million ounces. And yet, if there's a new center of gravity, that kind of offers resource growth beyond that. So really, this becomes
and mine design changes.
And mine design changes, but really, so in a sense, what it does, it delays the mine scheduling, but it advances the exploration side of the story. So this becomes a bit more of an exploration story again for 2023.
Yes and no, because I think at this point, people understand the value of potentially dewatering the shaft, getting back or driving in a ramp and conducting a more thorough, closer to the ore diamond drill program. And that shifts that, and then you could do some bulk sampling. Then you could do some more refined ore sorting tests to establish the right, cutoff and trade-offs with all these other things, and then and tests, and start testing how are you going to approach mining this.
So effective a twofold approach. One is to de-risk. Potentially with dewatering and underground work, to de-risk the restart, and the other is to prove the scope of the scope and the scale.
Absolutely, and keep in mind. So exactly, Merlin. Continue developing and advancing what needs to be developed, and obviously is going to be a mine, which is Chimo, and then at the same time, design a program to expand the system and continue to explore along that 15-kilometer strike. If you go to our website, you'll see the maps where the new ground that we've acquired via O3 offers several other historically discovered and drill indicated gold systems. And who knows, maybe the East Nordo deposit, which has really high grades, will be the ultimate mine, big mine on the spot. Right now, we've always been looking at Chimo because,
you're anchored by the shaft.
We're anchored by the shaft, and it's the drunkard's fallacy. There's a story where there's a drunk man trying to find his car keys in a parking lot. And you say, hey, exactly. Well, why are you looking there? Well, that's where the lamppost is. And he's not thinking that maybe just off to the right here where there's no light that he might find his keys, right? We all know that story.
I come back to finance and your shareholder register. So you've got two fantastic corporates on your shareholder register. You've got Agnico Eagle, you've got O3. They're at 16% and 15% respectively. I don't see
Quebec Sovereign Funds.
And the Quebec Sovereign Fund, but I don't really see kind of an institutional list that's going to kind of help you finance through this. Is that the target? You're working on that.
Yeah, of course. Because that's when you remember earlier on in the interview, you asked me, what's new in the environment? Well, there has been recent merging between the large companies, and they've created a vacuum between themselves and the junior producers that don't necessarily have the ability to pay this type of project. They have a strategic interest to acquire a project like Chimo, but not necessarily the ability to pay. And we're seeing that some of the investment funds, gold-focused investment funds, are looking to occupy that space and to arbitrage through funding or participation in the next steps. And it so happens that their trigger is not a resource estimate, but documents such as a PEA or a pre-feas. That's where they get involved. And they say, well, we could put our weight behind this and we will become that institution that will take you from a PEA to a pre-feasibility or feasibility, which requires sometimes $50 to $100 million worth of additional work, right? Because it's a multi-level approach: expansion drilling, infill drilling, permitting, environmental baseline studies, underground exploration programs, bulk sampling. So it's like a multi-level program that needs a lot of money that they can only offer.
I think you're absolutely right. It doesn't need to come immediately. You don't need it all tomorrow. But
they have to see the value of investing.
They have to see the value in investing now. And of course, with your market cap at $30 million, you don't want to blow out your share structure. So really, for me, the story, you mentioned the story as being, delivering on your goals this year, which are drilling in the PEA. I would like to see kind of the third side of that, which is the kind of growth of the shareholder register and responsible funding going forwards.
And I'm saying publicly, we're working on that.
Well, thank you so much for the update. It's always interesting speaking to you, and I really like the geology, and good luck to you and the company.
Thank you.